OSFI, otherwise known as the Office of the Superintendent of Financial Institutions, has reviewed the national stress test used for qualifying for mortgage purposes. And there's some good news for Canadians heading into 2022. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so welcome back. Today we're discussing OSFI, the Office of the Superintendent of Financial Institutions, and the recent review of the mortgage stress test, which is the stress test used to qualify people for mortgages in order to ensure that in the event that interest rates went up, Canadians would be able to handle the increases in interest rates. And as of right now, we're seeing about 90% of people have now qualified under the existing stress test rules or some sort of stress test rules before them. And this is a really good thing for Canadians. But before we get into all the details and discuss exactly what's happening, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, which has now turned into our race to 20,000 subscribers. As of today, we are just 150 subscribers away from hitting 20,000. And if we hit that number by the end of the year, which it very much looks like we will, we're going to give away an additional $1,000. And who knows, maybe we're going to give away $1,000 per 1,000 subscribers for the next 5,000. We'll see. I'll give you some details later on. But if you want to enter for that $1,000 when we hit $20,000, you have to do two things. You have to be subscribed and you have to leave a comment in one of the videos leading up to the new year. So go ahead, click that subscribe button. It's free, it's easy, it's definitely worth it. And leave me a comment. Tell me what you think of OSFI's new stress test rules and the changes or lack of changes that they've made. Or tell me what you think of my videos in general, or just give me some sort of feedback. Leave them in the comment section below. Somebody who comments and is subscribed is going to win that $1,000. And let's get into the video. Let's talk about OSFI and the changes to the rules, or the lack of changes to the rules for mortgage qualification. So here's what's happened. Every year, this started actually in June, it was announced, every year in December, OSFI, the Office of the Superintendent of Financial Institutions, this is the bank regulator, is going to review the mortgage stress test. And subsequently, what they're going to do is they're going to look to see if it is in line with current market trends. And this was something that was very much lobbied for by mortgage brokers, mortgage lenders, realtors. Pretty much across the board, anybody involved in real estate was lobbying for, in June of this year, the onus of the stress test be taken off of banks. Because if I give you a little bit of background, a little bit of history on the stress test, it started in 2016 with all CMHC mortgages having to qualify at posted rate. So when you were getting mortgages in the 2.5% range, you were having to qualify at around 4.75 to 5%. And then in 2018, OSFI decided that that was going to take place across the board for all mortgages, with one small change. They were going to also introduce a plus 2% over the contract rate criterion. So in other words, if you have a mortgage and you are paying 3.5%, your qualifying rate would be either 5.5%, so the 3.5% plus 2%, or it would be whatever the Bank of Canada's qualifying rate is, which right now is 5.25%, whichever is higher. So this stress test has evolved over recent years, again, starting in 2016 on insured mortgages, and then coming into play on pretty much all mortgages in 2018. And then in June of 2021, it became clear that leaving this in the hands of the banks, where they got to choose their posted rates and choose whether or not to lower them or increase them at their own will, was pretty much not in the best interest of Canadians. So OSFI took over the role of taking care of that qualifying rate and determining what it would be on an annual basis. And it just happens in December of this year, it was up for review, and there was a lot of hesitation, a lot of nervousness around what OSFI was going to do. And they decided to leave the stress test at 5.25%, not increasing it, not decreasing, leaving it exactly where it was. And there's a lot of reasons why this is a good thing. Obviously, lowering the stress test would have added more fuel to the fire in Vancouver and Toronto's markets. And the other side of it was, if you increase the interest rate, increase the stress test rate, it would have had a negative effect on those who are more in need of the ability to qualify for a mortgage. Because this is what's happening across Canada right now, is you're seeing a disproportionate impact to those who have high income, high paying jobs versus those who have low income, low paying jobs. And if you were to increase the stress test right now in order to cool the housing market, which a lot of people were calling for, well, you would adversely affect the lower income people more than you would affect the higher income people, and it would very much have caused a further gap in wealth in Canada, especially when it comes to real estate. So I think it's a good thing that they left the stress test exactly where it is. Again, that qualifying rate is at 5.25%, which means even if you're getting a mortgage at 1.15 or 1.2%, which you can on a variable rate mortgage right now, you're still being qualified at that 5.25% rate. And then subsequently, if interest rates go up, you know that you are meeting the minimum qualifications for being able to pay that higher interest rate, which means there's a pretty big buffer in Canada in the event that interest rates should go up. So if I take you in here, and I'm just going to pop you into my screen, show you the news reports on this. We're going to use Reuters today because, heck, we haven't used Reuters in a while. Canada keeps mortgage stress test benchmark unchanged despite hot housing market. Obviously, they go through all the details here. So the other thing that you need to realize as well is that while OSFI made this change for uninsured mortgages, the Department of Finance at the same time also came through and said that they were going to match the rates that OSFI has decided are the best stress test rates. So that means that this is across the board, not just for uninsured mortgages, but for insured mortgages as well. Now, interestingly enough, I think there was another news article that's very relevant and very timely here, especially when you have people who considered the stress test to be one of the ways to cool the housing market. And this is CIBC's Dodig, I think that's how you pronounce his last name, saying it's time. The time is now to act on Canadian housing prices. And what he is not necessarily suggesting is more regulation, but what he is suggesting is more building, more access to supply, and basically, like we've said in previous videos, the federal, the provincial, and the municipal governments giving their heads a shake and making it easier for home builders to build more properties, build more houses, build more supply, so that the pressure can be taken off of the real estate market. And realistically, this is the only way that we're going to fix this whole thing, aside from maybe having a massive crash in real estate prices due to a liquidity crisis, which I certainly hope doesn't happen. But the only way we're really going to fix this thing is to build more houses, and probably by building significantly more houses than we actually need, and actually overshooting the supply that we should actually be building. And, you know, I think that CIBC's comments here with respect to adding more supply are really, really, really important, because they point out a few things. First and foremost, they point out that municipalities have to get their act together with respect to allowing home builders to build more houses. Basically, the municipalities have to pave the way for home builders to build more properties. That means creating more infrastructure. That means taking and getting rid of the red tape, basically allowing that home building and that expansion to happen. But then what the provincial and the federal governments need to do is they need to support this by incentivizing builders to act and build more houses and build them faster. This is really the reality of it, is we have a housing shortage, and until we have more housing and we have more availability for properties, we're not going to see the massive amounts of housing prices and the massive amounts of increases that have come to our market basically go away. So, you know, I think there's some really interesting points here as far as how this affects most people right now. Well, first and foremost, most of us have been qualifying at 4.79 for quite some time now, and therefore we don't really need to worry about whether or not we can handle higher interest rates. If interest rates go up 8 times, which is what the Scotiabank economists have predicted, in a worst case scenario, they could go up. Well, guess what? That means that even if they go up 8 times and you have a 2.5% mortgage right now, interest rates are only going to go up to 4.5%, and you have therefore qualified for even higher of a rate than that. So most Canadians are in a place where they would be able to withstand a pretty significant increase in interest rates. And ultimately, while we would all see it affect our pocketbook if those interest rates did go up, it isn't going to be the end of the day for most people, especially if you've been planning for it. And if I were you, if I were a consumer, what I would do, and we've talked about this a lot, is I'd be using that qualifying rate, that 5.25%. I'd be figuring out what the payment would be for your size of mortgage and your amortization of mortgage. And I would use that as a baseline for the type of payment you should get used to paying. Then what I would do is I would take that payment and I would subtract the actual mortgage payment that I'm making right now, and I would take that difference and I would start setting it aside in some investments. There's a link in the description below where you can purchase through Questrade EFTs for basically free. I would be going and I would taking that money and I would be transferring it automatically, so I'm learning to live without it, into an investment account so it grows, so that if interest rates do eventually go up, and they may go up, they may not, but if they do eventually go up, you've got that money set aside. So this is all about good financial planning. The stress test is all about good financial planning for Canadians. It's forced financial planning, making sure that people can withstand the interest rates that they are paying. But if you're smart and you take a cue from the federal government here and you say, okay, I'm going to use that number as well, and I'm going to use that as my suggested savings that I'm going to make every month. I'm going to learn to live without that extra money, and I'm going to put that aside. Well, that's really prudent personal financial planning as well. So I think at the end of the day, OSFI has the right to go and take a look at these numbers if interest rates do start to go up prior to next December. If they do, we may see changes prior to that, but more than likely what we're going to see is changes to this stress test at the end of December next year. And I'm going to guess around that time, there's probably going to be a pretty high likelihood that we're going to see that stress test change next year. And ultimately, it's going to get higher as interest rates go higher. Now, does that change our whole variable versus fixed strategy? Well, you can go and check the other videos on this channel where I talk about that quite frequently. Still a big believer in variable rates. About half of Canadians are choosing variable rates right now. Although, if you go back for about 5 years, about 3/4 of mortgages in Canada are 5-year fixed. But variable rates are very much the choice right now, because we know from Mosh Milewski and has studied from the Schulich School of Business that when variable rates and fixed rates have a big gap between them, then variable rates tend to win even in environments where interest rates are going up. So we know that we've got this big bandwidth if you're choosing a variable rate over a fixed rate right now to save money. And I'm a big believer in locking in, but I believe in locking in savings by taking a variable rate, keeping that cash myself rather than paying it to the bank just in case. And if interest rates don't go up as much as it's predicted, you end up saving that money, but you don't expose yourself to basically giving it to the bank for a 5-year period blindly, and then also expose yourself to higher payout penalties by way of having a 5-year fixed mortgage. So I do believe variable rates are highly flexible. Flexibility matters, especially in a high interest rate environment, especially if you decide you want to offload a property at some point, because payments are starting to feel like they are too high, and variable rates, because of their 3 months interest penalty, are going to allow you to do that. So those are my thoughts on OSFI and the new stress test, or the old stress test, or the unchanged stress test of 5.25%. If you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about that race to 20,000 subscribers, and we'll see you on the very next one. Cheers.